Hey guys, John Polemy here, Actionable Intelligence. Today is Sunday, October 18th, and this is the weekly market update. So, in this week's reality check, I want to review an article that I read this weekend and also heard the interview on Financial Sense NewsHour, Jim Poplava's site. And the article was written by Louis Vincent Gave, and it's from GovKel. They do research and I think money management in France. And the name of the article is Cover Your Ass, the Guiding Principle of Our Time. And the question is asked at the beginning of the article, what is the dominant guiding principle of Western societies today? And Mr. Gave goes on to say, at the risk of sounding crass, let me suggest it is the, quote, cover your ass or CYA principle. This principle has always been fairly prominent in participative democracies, but now has gone into hyperdrive. So much so that the CYA principle is also now an important driving force even in financial markets. So he goes through and discusses various examples, and I think this is probably one of the best well thought out articles I've read in a very long time, because it basically, people I think ask the question, like, why is there so much stasis in our leadership? Why is there so much inability to solve problems? And so we have the population in these democracies, in the Western democracies, vacillating back and forth, between Democrat, Republican, between socialist and center right or whatever, back and forth in Europe, back and forth in the US, and nothing ever gets solved. And you have these huge problems that we can go down the list. We talk about the declining middle class, the impending issues with the pensions in the Western democracies, automation, the hollowing out of manufacturing and decent jobs for the middle class, upward mobility, wealth gaps, all these issues. And I think when he gets into this, he talks about using, for example, like COVID as an example. I think it was a good example. I remember if you go back and look at some of my videos from like March, I kind of shut it down. I didn't talk too much about it because, first of all, the YouTube and everything was censoring. They didn't want to have any kind of discussion around any alternative discussion around anything that deviated from the, shall we say, establishment narrative. And I had went out and looked. I'm not a scientist. I know nothing about viruses, but I did a bunch of research, and I'm not talking about fringe people like Plandemic or videos like that. I'm talking about people that are epidemiologists or study diseases and pandemics, people with credentials, and they were given no voice. John Ioannidis at Stanford University is a perfect example. Other people that study these viruses, okay? And, what we saw here in this huge reaction. Now, when we initially had this, of course, leadership is going to react and because there was a lot of unknowns, shall we say. And then, we were originally going to flatten the curve. We didn't want the ICUs to be overrun. That was the big danger. And we didn't have enough ventilators. We didn't have enough masks, blah, blah, blah. And those never really became real problems. And now we're, coming up into the fall, and we've seen examples in various countries that didn't lock down, like Sweden, Belarus, some other ones, and their curves are down. Their death rates are down. They're comparable with surrounding situations. They didn't lock their populations down. And you see different policies here, even in the U.S. And then we see some, states opening up, and then some people saying, well, we're not going to open up again. Somebody in the Army just said recently, we're never going to go back to normal. So what I'm saying to you is the article kind of talks about, uses an example of the overreaction by politicians in leadership, because they don't want to be seen as doing nothing. They don't want to, we have a 24-hour news cycle. We have this whole Twitter sphere where everybody has an opinion, everybody has a say. The public, the mob is screaming all the time and throwing rotten fruit at everybody, figuratively. And, you don't want to be on the wrong side of that. So you CYA and you overcompensate or you overdo things. That way nobody can come back to you and say, you didn't do enough, and now this happened. You can never know an unknown. No one can know the future. And like I said, when we started doing these lockdowns, and even now I say the same thing, no one, you can count the knowns. We know how many people are out of work. We know how many businesses have been destroyed. But, we couldn't anticipate all the other things, the suicides, the domestic violence. A lot of the other things were not anticipated. But there's no discussion around that. And he goes on to talk about, perfect example right here. He says, now that every policy choice is reviewed and debated in real time by millions of people around the world, CYA has become all important. Politicians have to put policies in place to hedge against the wildest tail risks imaginable. That's what we thought, right? I mean, you would have thought that this COVID thing was going to be like a zombie apocalypse. At the same time, the first instinct of policymakers and of investors, but more on this later, is to avoid doing anything that diverges too far from the pack. Any policymaker anywhere looking at the opprobrium heaped on Sweden will surely agree with John Kenneth Galbraith's observation that, quote, it is far, far safer to be wrong with the majority than to be right alone, unquote. It's absolutely true. This is absolutely true. He goes on to talk about the policy responses after COVID, not just with COVID, but in 2008 during the great financial crisis, the tech bubble blow up, and the view that I've talked about before that we never let the market clear. We never are going to let anybody feel any pain. We're not going to let anybody go out of business. I've talked about this before. Before COVID, I thought the instrument of our destruction was going to be the corporate bond blow up. 25% of the companies in the S&P are zombie companies. They don't make enough money to literally pay the interest on their debt. And I thought that was going to be, the next recession we had was going to push that corporate bond defaults into, record into the stratosphere, and that was going to be the next financial crisis. Lo and behold, I didn't know that we were going to have a virus and have an overreaction by government officials and then have the Treasury and Fed conspire to buy the debt of, corporate debt and basically, head off that day of reckoning. There's nothing wrong with poorly run companies going out of business. Those assets, the ideas that are in the company, the patents, the facilities, they don't go away. They just change hands from people that are mismanaging them to people that can better manage them. It's called creative destruction. And it's necessary just like it's necessary to burn off the underbrush in a forest. And if you let it build up, if you don't let it clear, you see what happened in California. They didn't manage their forests properly. Environmentalists wouldn't let them do preemptive and prophylactic burns to clear underbrush, to manage the forest properly. And so when all this dry tinder and garbage and waste, forest waste built up and something set it off, you have these humongous wildfires. And it's the same thing in the financial markets. We have policies from the government and from the Federal Reserve that create distortions in the economy. These distortions build up over time, and then they come home to roost. They manifest as a crisis, and then there's larger and larger amounts of more intervention needed to deal with the former built-up distortions and the current distortions. And it just is never ending. Because, who's going to step up as a politician and say, we're just going to let the market clear, we're going to let banks go out of business, we're going to let poor-run businesses go out of business. I mean, you'd have, we're to the point now where, you're not going to be able to allow 10, 15% unemployment. You'll be thrown out of office. You'll be thrown, the 2 and 4 year election cycle doesn't allow for it. And now there's so much distortion, there's so much intervention, there's so much manipulation that you can never now let it go down. Policymakers are so afraid of any type of market clearing event, any kind of deflationary debt collapse, that they're going to do whatever they need to do. I was listening to a podcast, an interview with Grant Williams and Bill Fleckenstein with Felix Zulauf, and they were talking about the debt and the MMT that's coming down the line. And Felix Zulauf says, I listen to these podcasts when I'm driving back and forth to work, and I almost drove off the road. He says by the end of this decade, he can very easily see the Fed's balance sheet at $40 to $50 trillion. I mean, that was shocking. And this is a guy who used to be on the Barron's Roundtable. He is not some whacked out conspiracy guy or whacked out financial guy. This is a legitimate guy that's been around for 40 years, a Swiss money manager, a market historian, somebody that's been through all kinds of bear markets. And I mean, it's a very interesting interview. Of course, I'll put a link to that on my other site on Blogspot, where I catalog all of the great interviews that I do listen to. But, that's an example. They can't at this point. If in a Western democracy, if we let things actually clear out, it'd be French Revolution time. It'd be Russian Revolution time. Heads would be getting chopped off. Things would get so bad. So the interventions will continue. The market distortions will get bigger. But as speculators, that is what is necessary. It's not necessary, I guess, but it's provides prime hunting grounds for speculators because there's so much opportunity because of these distortions to take advantage. So that may sound bad to some people, but I don't make the game. I don't make the rules. I'm just in the sandbox that somebody else put together. I've said before what I would do if I was king for a day, but that will never happen. So, we don't operate with the way we want things to be. We operate based on how they are. Going on, he goes on to say, moving on to the far less controversial fiscal and monetary policy responses to the recession, can there be any doubt again that policy has been driven above all by the CYA principle? Absolutely. What policymaker wants to espouse the Hippocratic principle of first do no harm and let markets and prices find their own footing? None. That's absolutely right. As Anatoly has argued, policymakers are scrambling always to do more with ever bigger budget deficits funded by ever more money printing. So I'm going to put a link to this article. I suggest you read it. I don't know if the interview is available. I think it's behind a paywall at Financial Sense NewsHour. But I've always recommended that people get a subscription to that. They have a weekly market update there. Plus they have 3 to 4 interviews a week or book reviews with very smart people. And it's about $100 a year, but I think it's well worth it. But anyways, this article, I'll put a link to it. It was on Zero Hedge and on the GavKel website. I'll put a link to it. I'm going to reread it again. It was really an excellent article, and it really does quite accurately describe the current situation. And, a lot of people subscribe like nefarious, New World Order, cabals they're using these crises. I mean, no, that's not what it is. These people that are in politics and policymakers they're just dummies. They want to keep the game going. They're part of a club, and they want to keep it moving forward. Because of the life that they enjoy inside of that. There's no big conspiracy. I mean, you can't get 3 or 4 friends to agree to go to the same restaurant or movie, and these people are somehow getting together in some cabal. I don't buy it. What I buy is a bunch of dumb politicians, sociopathic tendencies, narcissists, people that are able to cream off the good life, ne'er-do-wells, and they want to keep the game going. So they'll do and say whatever they need to do to keep it going, and, and then leave. No one's incentivized on a 2 and 4 year election cycle with Bubis Americanus pulling the levers to fix the long-term problems. Social Security and Medicare will not get fixed. The debt will not get fixed. The pension problems in this country will not get fixed. The declining middle class will not get fixed. We're in a country in decline with a lot of problems and no leadership. And if the guiding principles CYA, they're not going to get fixed. So no need to cry about it, no need to get upset about it, no need to go staple a piece of cardboard to a stick and go protest. You just need to assess how things are and then look for opportunities where the government and our political class create opportunities for us to operate as speculators. That's my advice. But it's an outstanding article. Wanted to point this out. Another excellent interview on Eric Townsend's Macro Voices. I'll put a link to it. It was Mike Alkin, who many listeners here are familiar with, of the Sachem Cove Partners fund that does uranium investing, and Guy Keller, who's the Tribeca. I think they have a uranium fund. It's based in Australia, and Eric Townsend interviewed them. And Mike Alkin shared it was on Twitter, various people, but they have a new presentation out about the uranium market. I'll put up one slide here, but I'll put a link to the overall presentation, which I suggest you take a look at. What I wanted to put up here, this on the left is the previous bottom in the uranium market back, over 10, 15 years ago. This is the current and going forward. What you will note is that the title of the slide is materially better setup now versus prior bottom. This dotted line is the uranium requirements in hundreds of millions of pounds on the left. This is the uranium price on the right. And you will note that for the most part, after we made the all-time highs in uranium price, we never really were in a big deficit position with uranium supplies. And the contrast here is that we are, in fact, in deficit and will continue to be in deficit as the forecasts are showing. So, the question is how much supply is still out there to be chewed up as far as this production, existing production, and secondary supply. How much overhang is still out there, and before this fact can kick in and allow for an increase in price. And we've been talking about this for a couple years, and nothing's happened, and people have become discouraged. But I am not. Like I said, I've said this over and over again, and I'll continue to say it. Supply continues to decrease. We are living off investments that were made in uranium mines over 10 or 15 years ago. Those are coming up to exhaustion. No one is committing new capital to build new uranium mines, but there are all kinds of new nuclear plants being built. So demand is increasing and supply is contracting. And I think this bull market that's going to happen, as I've said before, I believe will be bigger than the last one, simply because there's going to be such a time lag before the price signals become high enough to incentivize new mines to get built. That deficit will be there, and it's going to be a game of musical chairs for the consumers of uranium. And I see no abatement in the building of nuclear power plants around the world. Maybe in the United States and Europe. Like I said, they're becoming less and less relevant. I'll have a slide later on about that. But the rest of the world is moving forward. Over 50 reactors currently in construction, 100 some odd reactors in the planning stage, and 300 and some odd in the proposed stage. So it's moving forward, and it's just an inevitable situation. The interview is very good. The slide deck's good because it focuses on some other issues around, the investable universe of uranium stocks. There's probably 40 or 50 companies, but half of them aren't even investable. And that's something I think a lot of people forget. As we continue to see dilution and announcements of companies having offerings, you really should be in cash conservation mode now. If you're one of these juniors, but that's a conversation for another time. But that is discussed, and I think that I'll put a link to the interview. I suggest you listen to it. It's pretty good. Again, Mike Alkin and Guy Keller from Tribeca. So, I continue to be bullish on oil, medium and longer term. I sound like a broken record. But, more and more facts are coming to light, I believe, that are leading me to believe that I'm on the right side of this. One of the things here is a little factoid here. Oxy CEO says U.S. oil production will never see pre-pandemic levels. America's oil production will never again reach the record 13 million barrels a day set earlier this year, just before the pandemic devastated global demand, according to Oxy Petroleum Corporation, Occidental. Quote, it's just going to be too difficult to replace the 2 million barrels a day of production that we've lost, and then to further grow beyond that, Chief Executive Officer Vicki Hollub said Wednesday at the Energy Intelligence Forum. Over the next 3 to 4 years, there's going to be moderate restoration of production, but not at high growth. And that's what a lot of other people are saying too. And we need to note that because of the tremendous growth in the shale oil production, a lot of other production around the world, a lot of other reserves, a lot of other investment didn't happen because of this production coming online. And it filled a void. And as this doesn't come back, if you are a believer that demand will come back, and I am, to pre-pandemic levels eventually, we're still, not far off the highs if you look at Chinese data and some other places. Again, we're in another situation where the price of the commodity is not sufficient to lead to more investment that's needed to replace the reserves that are being pumped out of the ground. One of the things I did like what she said, I found interesting, it says, unlike some of her European peers, Hollub sees strong long-term demand for oil. Quote, I expect we'll get to peak supply before we get to peak demand, she said. And I thought that was interesting because that is flying in the face of what we're seeing as the current fashionable opinion regarding energy markets. We've seen the end of demand. We're going to electrify everything, ESG, blah, 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 beyond petroleum, all that stuff. And I don't believe that. I think the emerging markets have, we have 3 billion people that have a long way to go in their oil consumption S-curve growth. And that's going to present an opportunity. In fact, I think people are going to be shocked how high the oil price goes over the next few years. Another good or interesting article, I should say. I don't want to get into confirmation bias, but some of these things are very interesting. They need to be taken into consideration because these are things that I believe are correct assessments. QEP's Vil Van Loo says country's oil production capacity is lower than believed. He's talking about the U.S. He goes on. This is a this is a private trading firm, oil trading firm. And what they say is a fracking binge in the American shale industry has permanently damaged the country's oil and gas reserves, threatening hopes for a production recovery and U.S. energy independence, according to one of the sector's top investors. Quote, that's the dirty little secret about shale, unquote, Mr. Van Loo told the Financial Times, noting wells had often been drilled too closely to one another. Quote, what we've done for the last 5 years is we've drilled the heart out of the watermelon, unquote. So this is, some people were suggesting this was the case, that the tier one, if you want to call it, the low-hanging fruit, high grading, that was the opinion of Goring and Rosenzweig and some of their analysis. And if that's in fact the case, then even if prices do go higher, we may not be able to restore the production that we saw in the past, and that would corroborate what the CEO of Oxy has said, and many others, by the way. It's not just the CEO of Oxy. I mean, we were having, before we had the shale revolution in the U.S., we were, drilling further and further offshore, talking about drilling in the Arctic. If oil is that plentiful, we wouldn't be going to these way out, high risk environments to try to get oil and gas. So the shale phenomena was I think a one-time roll of the dice, and it's over with now. As far as the growth, mega growth we saw, I said this in a previous video. I haven't dug the articles up, but I should go back and try to look in the Wayback Machine. There were people during the heyday of Drill Baby Drill and all that stuff that were suggesting that U.S. production could get to, 15, 20, 25 million barrels a day, and we were going to take over the world and be the new Saudi Arabia, the new big dog in the oil industry. And now, maybe it's a matter of just sentiment being low that everybody's pessimistic. Maybe the truth is somewhere in the middle. I don't know. But what I'm doing is looking to places that have trophy type assets, long reserve life, indexes that already have a lot of their capital spent. And what am I talking about? I think there's tremendous opportunity in the Canadian oil sands. You look at companies like CNQ, Suncor, they're very cheap. They have spent a lot of money, billions of dollars, building out their facilities. Those facilities are up and running. And they have reserves of, 40 to 50 years. And if oil prices get back to 70, 80, or 100 or 100 plus dollars a barrel, these things are money machines, and they will have tremendous moves. So it's something to look at. In fact, if we don't think that the oil demand is really going to go away like many people are thinking. Here's a chart from Jesse Felder, another guy I've been following lately, pretty good. You can make these charts about anything, right? Gold versus this, gold versus that, gold versus oil, whatever. But I thought it was interesting because this is a gold to Dow Jones Industrial Average ratio. Basically what it's showing you is that even with the big run we've had in gold lately, relative to stock prices, gold is still fairly cheap. I mean, you go back to the last big bull market in gold, and the gold to Dow Jones Industrial Average ratio got to 0.8. We're down at like less than 0.1. At the last big move that we had in gold back when it made its previous recent high, it was like 1.5. So we have a ways to go, I believe. I think that as things move the way we think they're going to move relative to government policy, monetary policy, and the way that the governments are going to try to deal with this debt, it's a perfect environment for hard assets, gold in particular. And I think that, you have so many people on the side of the canoe with high tech and, Facebook and the FANG stocks and all that. These things don't go to the moon, right? They get overvalued, and then you have mean reversion. And I think this is a perfect example. So when people ask me if I'm still bullish on gold, yes, I am. I don't try to time these things. I made a video earlier this week, and I've been nibbling back on some of my gold stocks that I like. I mean, I keep my core position, but I traded out of Caledonia. I'm back in it. You can check that video out. It was earlier this week. And, I think, again, this decade, I believe, I just don't see how they're going to get out of this any other way except for debasing currencies, all kinds of funky tricks that are not going to lead to a lot of stability. And there's going to be a lot of instability. There's going to be a lot of crisis, let's put it that way. And I think that that's going to be good for gold. Another thing I wanted to point out, this is a pretty good tweet by a guy that I like following, Meb Faber. And he asked the question, I forget what there was a question above this tweet, but basically talking about market caps of the world and what was the percentage of emerging markets level of GDP relative to the U.S. It's 60%. And we've seen that a long time ago where the rest of the world is increasing as they urbanize, as their economies grow, their percentage of world GDP continues to go up. And that's going to continue for decades. That's what I've been telling people. And that's not going to stop. Other countries starting from a lower base that are, opening up, pursuing economic policies that are conducive to capital formation and to growth. That seems to be the movement around the world, the Western democracies that are moving more to a socialist, statist stasis, if you will. And so the correct answer here is that 60% of the outside the U.S., that's how big the economy is, but the emerging markets market cap is only 12%. and the average U.S. allocation to emerging markets is only 3%. So you have a valuation discount of 50% to the U.S. So there's a tremendous opportunity in emerging and frontier markets. That's what I've been telling you. You look at a country like the country of Georgia. It's in the top 10 in so many metrics as far as capital formation, ability to start a business, less state intervention in the economy, corruption indexes. They've been moving in that direction. So there's tremendous opportunity in a country like that. You're seeing it across the continent of Africa. There's 50 some odd countries there, so you can't just make a general statement, but there's many countries there. Rwanda, Tanzania, various countries that are changing, becoming more market orientated, okay? And they are seeing tremendous growth, okay? And their markets are extremely cheap. I've talked about Uzbekistan, okay? I've talked about Myanmar. I'm talking about these places that are basically starting out at such low levels and they have nowhere to go but up. And they are shifting from being statist, having a lot of government intervention in their economies and going the other way, becoming more capitalistic, if you will, while we in the West are becoming less capitalistic. So that is a arbitrage opportunity. It's also an excellent opportunity because it's an information arbitrage. It's not only an information arbitrage, it's kind of a mechanical arbitrage. What do I mean by that? You can't just pick up your phone and trade stocks in Uzbekistan or Georgia. You have to make an effort to do that. If you want to invest in some of these countries in Africa, you have to literally get on a plane. Now, there's other vehicles to do that, and we talk about that in the Actionable Intelligence Alert newsletter. Especially a deal that's just now happening that's combining one of the largest Canadian financiers with the top private equity firm in Africa. And there's a way to get into that's traded in the public markets. But that's an example. These places are going over the next 10, 20 years are going to be worth significantly more than they are now. And they have less debt. I mean, you look at a country like Uzbekistan, I mean, they've literally have almost hardly any debt at all. The debt to GDP is like 25%. There's no leverage in the economy. There's no government debt, corporate debt, personal debt. It hasn't been leveraged up yet. And that's just another opportunity as it does become leveraged over time that the market caps will expand. I mean, right now in Uzbekistan, for example, you can get, I think, something like in a CD or something, or a deposit in a bank is like 13 or 14%, and it's coming down, right? Because as inflation recedes in a lot of these countries, the ability of the banking system to lower rates, a central bank to lower rates, drag rates down, you still have high dividends in the stock market. I mean, you have companies there with dividends of 10, 12, 15%. So you're going to start seeing capital shift from people just putting their money into the short-term money market type instruments into the stock market, these equity markets. And the valuations are almost giveaway. I mean, they're not giveaway, but they're darn close to it. I mean, I've seen things 0.3 price to book, 0.5 price to books, things like that. I mean, your asymmetry in your potential over the next 10 years is tremendous. And the correlation to the West is probably, I don't know, but it's not very correlated. It's probably more inversely correlated than correlated. Somebody probably should do some work on that. So I think that this is an opportunity. I mean, I could do a whole podcast on this, and I probably will, because I need to get into it more in depth. But this is a tremendous opportunity, and with the communications we have now, with the ability to go to these different places, there's no reason not to be looking at the entire world. Don't just be a homer and look at, have home country bias. I mean, I get emails and letters all the time from people or messages. Why are you talking about Canadian stocks? Or why did you talk about Australian stocks? Or no one cares about, these things you're talking about in Africa. I think that's just myopia. You shouldn't think that way. I mean, there's tremendous opportunity if you have a long-term ability to think long-term. The amount of capital that's going to flow into these places is going to be tremendous. And we've seen it before. You know, I remember when I was younger, 20 years ago, when places like Thailand, Malaysia, these places were taken off. They called them the tiger cubs, tiger economies, you know, Taiwan, South Korea. And if you go back and look at the growth as the country's GDP grew and the market caps followed along and capital flew in there. So there was tremendous returns for those who recognize that. And the same thing's being repeated now. So it's something to think about. It's something to contemplate. I'll probably do another video on it because it probably requires that level of attention. All right, guys, that's it for this week. Appreciate the viewership, appreciate the support, and thanks for listening. We'll talk to you next time. Thank you.